Hey guys, welcome to another video, business plan and detailed calculations, where I will be calculating three main elements of a business plan: cash budget, income statement, and statement of financial position or balance sheet. However, I would recommend that before watching this video, you watch my another video, business plan, a detailed insight. In that video, I went through contents of a business plan and I discussed what they are and a bit of information on the contents as well. And then I released two articles as well about business plan, introduction to business plan, and then why should you write a business plan. I hope you have watched that video. I didn't get a positive answer from the previous video. You would have noticed that all of the business contents I have shown you in the video, on the blackboard, in the workbook are different. Not completely different, but there is a difference. And the reason is that different business plans would have different contents because businesses are all different. So that's why that makes sense. In each business plan, there are two main sections. Number one is theoretical. So in that you cover your introduction. You talk about your business strategy, you talk about products, you talk about suppliers, you talk about customers, you talk about your marketing strategy, all theoretical aspects. So if you're writing a business plan, then you should research into these areas, taking guidance from my articles and from the video. And the second section is all numerical, quantitative. And in that section, there are four major areas. Number one, financial assumptions. Number two, cash budget. Number three, income statement. And number four is our balance sheet. Four main contents, compulsory contents. Without these four contents, you would not have a business plan. You can also add things like we have learned in management accounting, break-even point, cost card for your products, contribution from your business, and target profit kind of exercises you can apply. The more you add, the better marks you get and more information you get. So the purpose of this class is to go through those financial aspects, four financial aspects. So the first part is financial assumptions. This is a good example. Okay, Diana Henley is an exercise, and your financial assumptions would look like this. And if you look at the video, I've shown you some of the assumptions there as well. So you should look at that as well. So what I am going to do is I will read this exercise. While I'm reading it, I'll put my data there. Yeah, page 100. Page 103. Very late now to do that person. Keep going. Diana Henley. Yeah, that's the one. You're missing it. Yes, Kareem. I should have let you have your cigarette.
That's 105.
The first part is financial assumptions. This is a good example. Okay, Diana Henley is an exercise, and your financial assumptions would look like this. And if you look at the video, I've shown you some of the assumptions there as well. So you should look at that as well. So what I am going to do is I will read this exercise. While I'm reading it, I'll put my data there, and then I will solve the answers, requirements. So the requirements are use spreadsheets to draw a monthly cash budget for the 6 months to 30th June. Your business plan should be at least for 1 year. Prepare an income statement and balance sheet. I'll rename this as my data, and the first thing is that Diana Henley is a sole trader planning to open a shop on 1st January next year. She will provide 50,000 cash. So when owners of the business provide cash for the business, it's called capital. And the value here is 50,000. and borrow 200,000 from a bank at 10% per annum. So that would be a bank loan. What writing down 10% per annum? At the same time, I think we should calculate how much interest we would be paying. Okay, interest, we have the amount. The rate is 10%, but this rate is per annum for 12 months. So, because this business plan is only for 6 months, we should 6 by 12 it. Yeah, pro rata times 6 divided by 12, 10,000. Item number 1 or assumption number 1, although these are also assumptions. Assumption number 1 is on 1st January to pay for premises 200,000. She buying her own building for the business. Fixtures 30,000 and land 10,000. Then we have to imply, so all of our capital expenditures done, to imply 2 assistants each at 1,300 a month to be paid before the end of each month. All this is happening so far in January. So then comes our assistants, shop assistants, and we have 2 times 1,300. She will be paying them for the duration every month, so we should cover the time period of our 6-month time period. There we go. Water pattern. And I will autofill it for the rest of the months. To buy the following goods in units. When we buy things to resell, we call them purchases, units, and 2,000, 2,200, 2,800, 3,500, 4,000, and 1,500. And point number 4 is sell the following number of units. So our sales in units are 1,200, 1,800, 2,400, 3,000, 3,900, and 3,200. Point number 5, units will be sold for £10 each. 1/3 immediately for cash and 2/3 on 2 months credit. So, price per unit 10. Our sales in pounds can be calculated by multiplying. This exercise is not for writing down.
I know,
Only
just like for
you
memorize. I have my laptop with me.
1/3 on cash, so cash sales total time divided by 3. And credit sales times 2 divided by 3. Yes, I think it's worth noting that we have 2 months credit on these. Number 6, the units will cost £6 each for January to April inclusive and £7 thereafter. This is talking about the purchases, okay? So what we need to do is we need to go to purchases units, insert a row underneath. Now you were writing, so try to insert a row on the paper. Cost.
I always look on Excel.
Cost per unit. This is a point every year I enjoy a lot, that when students actually writing, and I tell them, haha, I told you that use Excel. The question says use spreadsheet.
So please, I forgot my charger at home, so.
I can calculate the total cost. So purchases in pounds. And worth noting that there's a 1 month credit there. If I would be learning, I would be watching it, and then doing it on your own. But I would be doing it. Can I trust you to do it on your own?
Yes.
The units will cost £6 each, January to April inclusive, and £7 thereafter. Creditors will be paid in a month following purchases, 1 month credit, I have noted down, and value closing stock on a first in, first out basis. We will calculate that, but at this point I can do one thing, is that let's add up a total column here and sum up. Whatever I am going to do there. What we can see here that we have bought 17,800 units and we have sold 16,500 units. This gives us 1,300 units left in stock on 30th June. So this line is talking about these units, that these should be valued at first in, first out basis. This is not linked with cash budget at all. It is linked with income statement and statement of financial position, which I will do when the time comes. First we will do cash budget, so I'll leave it at this point. 7, the other expenses of the shop will be 1,500. And these could be utility bills, business rates. You receive a bill and then you get some time to pay them off. So there's a 1 month credit period there. There we go. Parts of the premises will be sublet as an office at a rent of 6,000 per annum. This is paid in each quarterly installment starting in March. So this is my rent income. The first installment will be received in March and the second will be received in June. 9. Ms. Hanley will withdraw 2,500 per month for her private spending. Okay, so it's called drawings. When sole traders and partnerships, when they withdraw money for their own use, it's called drawings. But large companies, in the previous study units, we looked at PLCs and limited companies. When they withdraw money from their business, it's called a dividend. What must be noted that drawings and dividends both are not an expense. Because if you remember, dividend appeared in statement of changes in equity, not in income statement. Income statement incorporates income and expenses, but that was in our SOCI, we call it SOCI, accounting statement of changes in equity. Similarly, drawings are not an expense, but they are a cash related item. So here we go. Deal with that. 2,500.
Sorry, question.
Yeah.
Yeah, you mentioned that drawings is related to, is like dividends.
Yeah.
But in case of dividend, it's from profits, I guess.
Yeah.
But drawings, at times, probably the particularly sole trader probably might just be in need. A sole proprietor might just be in need and decide to pull out from the business. So sometimes, I don't know, it's not from profits.
But an expense is something which is incurred for business. A payment which is made for business, because drawing is not made for business, so that's why it cannot be an expense.
I know. I'm not saying unlike dividend, it is actually from profits.
Yeah.
Yeah, but drawings sometimes it's not from profits.
Sometimes it's not from profit.
Okay.
Interesting thing is that dividend doesn't need to be from profits. Many businesses pay dividends even when they're making a loss. Yes, it's allowed. It's allowed.
It's allowed.
So your statement was half correct. I fully corrected it.
Thank you.
Good question. Well done. Depreciation is to be provided. Depreciation is linked with our assets, fixed assets, and then expenses. So I've discussed this bit and by giving examples. I've discussed this thing, depreciation. So I hope you have read that. If not, please refer back to those articles and from the book to read. But in short, depreciation is a method of spreading the cost of an asset over its useful life. Okay, so that's what is it. It's an expense. Okay, so let's put that here as well. It's not a cash expense though. So what do we have? Premises. We have 5%, state here, 5%, and shop fixture. Should have used at 10%, and when at 20%. Okay. This is an income statement and a statement of financial position related issue. So I will discuss it at that point. But what I have done, I have placed all of my data on the sheet, and you will see now it will be a piece of cake to do rest of the stuff. So let's do our cash budget. All right. We have 6 months timeline. A cash budget has 4 elements: opening balance, inflows, outflows, closing balance. Okay, so let's start with opening balance. What is our opening balance?
50,000.
For that, I'll open up another sheet called Startup Summary. So in Rocky, return on capital employed, and in the previous study unit, I discussed about the capital employed, fixed capital employed, and working capital employed. This is linked with that. So if you link it with that, it will make more sense. Basically, we have some money investment, and some of that is going towards our fixed assets, and some of this will be going towards our working capital. Okay, so capital is 50,000, loan is 200,000. We call it total investment, 200,000. From this investment, we are buying our premises for 200,000. We're buying fixtures, 30,000, and a van, 10,000. Whatever the balance is, would be left for our working capital. So fixed capital, we bought all of our fixed assets, and then whatever is left. So first we establish the business, and then we run the business. So all of the, so this is our opening balance. Now we start with this. So going to cash budget, equal sign, going to my amount, and I got 10,000 here. Using links is better because let's say later on I add up, let's say I spend 1,000 pounds on computer and printer and a laptop. I make a change here, and because I made a link, it will change everywhere. The whole thing will change. Inflows. Cash sales is our inflows. So looking at our cash sales, Control C, right click, link, sales done. Credit sales, copy, link, done. However, it's a 2 months credit, so the cash impact of these sales would be in 2 months time. So maybe we can extend our timeline a little bit. There is one more item of income or inflow, which is our rent income. There we go. That's our total inflows. Outflows. Heading is your choice, it's not compulsory. You can ignore headings if you like. Okay, the first inflow, if I go from the top, except our capital investment, the first inflow is our interest payment. However, this is happening in June, so let's fix that bit. So, Control C. Then we have shop assistants. Done. Purchases. 1 month credit. So sales, cash sales, other expenses. One month credit as well. And rent income drawings is an outflow. And I think I have covered up all of my outflows. Depreciation is an expense, but is not a cash expense. So what I can do is I can total up my total outflows. And this leads me to my fourth element of the cash budget balance, which will be my opening balance plus inflows minus outflows. Now I can input my opening balances for the rest of the month. So the previous month's is opening, closing is opening for the next 89. And you can actually have negative. So that's my cash budget completed. I'll do so presumably, because she's applying for a business loan, bank loan, 200,000, maybe this business plan is supposed to be written for that loan. And if this business plan is presented in this way to the bank for that loan, it will not pass. They will refuse the application because they will say that despite we are giving you £200,000 for your business, you are running into red in the second month of the business, and then you're never getting black. So this business would be in trouble from the second month, and definitely it can't go on. So there are certain things which could be done. So when we prepare a rough draft, first draft of our business plan, and we see the cash budget is the cash budget is like this, we go back to the owners or proposers, and we have a discussion and see where we can cut corners, where we can save and make it look black. So in this case, briefly, if I think about it, I think the main item here is premises. Does she need to buy the building? Because she can just rent it out, then she may not have to borrow 200,000. And then she will save 10,000, 20,000 pounds per annum on interest. But then at the same time, she will have to pay some rent, and she will lose money on the rent income as well. So you can do, when you're doing it on your own, when you will do it, you can input these, change these assumptions and see what is the impact. All you have to do is go back to data, change the inputs and see what is the impact on our budget. She can do with maybe one shop assistant full-time at the start, and then one part-time later on, and then eventually two maybe, but some money could be saved in this case. And the final item is drawings, £2,500 from the very start of the business. Initially, drawing is a bad idea. You have to sacrifice initially to get to your business to a level where you can start making money out of it. But from the very start, it's not a good idea. However, it must be noted that your business plan should incorporate the money which you want from that business. to run your house, to pay off your bills, and it should be able to provide you with that much money. And if it doesn't, then you should not start a business. It cannot be a bread maker for you. So it's a bad business.
So on that, how about if the one of the business structuring probably something like a salary for him or herself rather than drawing?
Rather than drawings?
Yeah, maybe a salary.
It's the same thing, potato, patata. Okay? You're taking money out of the business. Sole traders do run a payroll. I do run payroll for some of my clients. They're sole traders, but they're employers as well. You can get salary. You will have to pay tax every month. But if you do drawings, you have to pay tax at the end of the year and after 9 months. So drawings is actually a better idea.
Okay.
At this point, I think it's worth mentioning that sole traders businesses do not pay tax. This leads us to our next item, which is income statement for the period ended 30th June XXX. We don't know the year there, so let's leave it there. And I'll have two columns. And our income statement starts with sales. So revenues going to data, total sales 165,000 there, less cost of sales. Usually you would have cost of sales a figure on the income statement, and then there will be a figure, and then there will be a note where all of this is explained. When financial statements are small, things like these are usually given on the face of the income statement. So I'll just calculate rather than in a note, I'll just calculate it here. But you can always put a note there. Equation of the cost of sales we have discussed before, haven't we? In, what's the spelling? Inventory plus purchases less inventory, closing inventory. Business is a new business, so no opening inventory. Yeah. Purchases, going to my data, 114,100 less closing inventory. So let's go to the data sheet and get back to this point, 1,300 units at the end. What we have here is basically these 1,300 units are from these units, and the question says that the value of closing stock on first in first out basis. That means firstly we bought 600 units. Firstly we bought units at £6 per unit, and then we bought unit at £7 per unit. So assume that the one we bought first was sold first, and therefore the valuation should be done on the basis of the one we bought at the end. This means that we should value this stock at £7 per unit. Okay. Let's assume that we were left with 8,000 units. Yeah. In that case, what will happen? 7,300 were bought at 7, and 700 were bought at 7, and that's how we will value them. But in this case, it's easy peasy. Simply multiply this with 7, and you got your answer, 9,100. Income statement, link or no link, let's put the link. And this leads us to our cost of sales. Yep. Gross profit. $60,000. And after gross profit, you would usually see operating expenses and then operating profit for the companies you've already seen. In this case, we have other income. So other income would first come, other income. That's our rent receivable. Let's write it down as well. $3,000. And then we have our operating expenses. Okay, operating expenses. Interest is a finance cost, not an operating expense, so we will deal with later. Shop assistance, yeah. So we have that one, and other expenses. The values in the data. Alright, can we see anything else? Purchase is done, sales done, cash sales, other expenses, rent income done, and drawing is not an expense. So we have done with our operating expenses, but depreciation is also an operating expense. So this is the time we calculate it. So this will be done at the end of the period when we are making income statement and balance sheet. So what we need to do is we have 200,000 times 0.05, 5%. 5% means the life of the asset is 20 years. If you take away 5% every year, it will take you 20 years to take 100% out of it. So that tells us life of the asset. And this is for the whole year, because this is half a year, we do 6 by 12. Okay. Fixture, 30,000 times 0.1 times 6 divided by 12. And when 10,000 times 0.2 times 6 divided by 12. So every year we bought these assets, we did not expense them, but every year we will expense this much, and eventually in the relevant time periods, 20, 10 and 5 years, all of the cost would be consumed, all of the depreciation will be charged. So we will go to depreciation heading, let's make it heading, and let's make it a bit smaller. So what I do is and $515. Good. That's done. All of my operating expenses I have incorporated, and this will give me a operating profit figure, which is used for ROCE, if you remember. GP plus other income minus operating expenses, 30,900, and then we have our finance cost and finance cost is, yeah, 10,000. Our net profit is 20,900. There's no tax, as I explained, that sole traders don't pay tax. Sole trader business don't pay tax. The owners will pay tax. Interesting thing is, you'll see there's quite a handsome profit there. 20,900 pounds. Invested only 250k. 20,000. That's quite a good. If you calculate ROCE for this business, it will be great. But the cash budget shows a different picture. Cash budget shows that the business cannot carry on after second month. Completely different things. Balance sheet. Okay. Balance sheet. As at I'll have 3 columns this time, because I'll be doing the notes within on the face of the balance sheet. First item, so there are 3 things on balance sheet: assets, liabilities, and capital. Starting with our assets. Using so what assets do we have? We have these 3. So let's just use a link as well. Okay, so what I do here, I put a heading, cost of the assets, and accumulated. I don't have the whole space for that. So what I'll do, I'll just write down depreciation, but it should be accumulated depreciation. This is year 1, so it shouldn't be a problem, but every year depreciation will be charged, and you put it together and take it away from here. So accumulated depreciation so far is, this shouldn't be from income statement, it should be from another account, but we can use in this case from here 5,000, and it is called N net net book value. Cost minus depreciation, and this gives me the total value of the assets. Total fixed assets. Yeah. Current assets now. First one is inventory. Remember, you can always find inventory on the balance sheet. 9,100. Let's use a link. Then there are 3 common current assets. Inventory. 3 common current assets. Inventory. What are the 2 others?
Cash.
Cash, yes. And
Stock.
that's inventory.
Okay.
Account receivables, our credit customers, all right? Trade receivables, how much? 54,000 pounds. Depreciation, inventory, account receivables, these are called adjustments. So they are usually done separately out of the data. there is no cash in this business, remember? No cash. So that's it. Let's total these two up. 63,000. And if I total this and my assets, I get 295,600 pounds. That are my total assets. That's one side of the balance sheet. The second side is liabilities and equity. So, the first one is NCL, so we call it bank loan. We have got bank loan of 200,000. Yeah, we haven't paid back anything, so let's just get the whole figure. Yeah, 200,000. That's our non-current liability. There's no other non-current liability, so I'll go to my current liabilities. What do we have? What do we have, guys? First of all, bank overdraft. The question does not say that she has a bank account. Yeah. But the question is that if you have a negative cash balance, it can only be in the bank.
Okay.
You can't really have a negative cash in your pocket.
Yeah.
You can have an overdraft, so it will go as a liability. Shouldn't be negative though, okay? Because liability is a liability. So what we do, we put a negative sign and we convert it into a positive. What are the liabilities? Two main liabilities: payables. So trade payables, data, no cash budget. And I have payables. And there's one more, other expenses. And some of us have to go really far. If I'm missing anything, it will not balance. So let's do the capital now. Okay. All right, so our starting capital, opening balance. Now this is the bit which you would see in only in statement of changes in equity. Our opening balance, our profit for the year, our dividend, and our closing balance. In this case, it's being done here. So our opening balance was 50,000. Yeah. Our profit for the year is this is the income statement, 20,900, and our drawings are 15,000. Opening balance plus profit for the year minus drawings, because that's how it should be. So, thanks God, it's balanced. You know, accountants, at a certain, if you know an accountant, you know that at a certain point of the year, they sleep in their offices because their balance sheet is not tallying, and they can't go to sleep, so they stay in the office. It happens. It's very real, you know. Nowadays, you know, this is all done on Excel. Nowadays, all of the bookkeeping is done on software, so you don't have to worry about this because software can calculate these things all the time. The problem still exists with the adjustments, and which can be very complicated. If you're using a business plan, guys, make sure your balance sheet tallies. So these are the 4 financial aspects of your business plan, guys.
Thanks for watching this video, guys. I hope you find it useful, and I'll see you in another video. Bye.